Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Pankaj Murarka of Renaissance Investment Managers. The case for a chat in today's show is simple. Is the pain in the broader markets likely to continue? Can the stress test actually result in further stress for these mid-cap and small-cap markets? And of course, Pankaj specializes in trying to figure out what are the themes that will be the next 5, 10, 15-year themes and which are not discovered by the market. We try and talk to him a bit about that. Pankaj, great having you. Thanks for taking the time out. Hope all is well.
Good morning, Niraj. Absolutely. It's a pleasure always to talk to you and your viewers.
Thank you, Pankaj. Pankaj, I'm throwing in a bit of a spanner in the wheels, if you will, because the last few days or the last month and a half has been marked by severe volatility and downsides that have come in at the broader end of the spectrum. Is this the end of the small cap story for the time being?
No, not really, Niraj. I don't think so. Just to put broader views in context, I firmly believe that we continue to remain in a bull market. Having said that, it's a matured bull market because this March, this bull market is now 4 years old. Bull market started in the middle of COVID lockdowns in March of 20. So what I would like to highlight is this is a matured bull market. In that context, I think, and given the fact that it's a matured bull market and equity as an asset class tends to be volatile, I think that's the nature of the beast. There will be volatility. Last year, calendar year 2023, we've had euphoric moves in mid caps and small caps. So we're seeing some pullback of that. Obviously, there are pockets of markets, and more so in mid caps and small caps, where there is a significant diversion or gap between fundamental valuation and stock prices, and there'll be a mean reversion. So I think we're going through that. I think it'll be a good and healthy correction in the market that we're undergoing. And I still think that the broader bull market from equities perspective remain very much intact. My view is that we are somewhere mid-cycle in this bull market. So I still think that this bull market has a longer to go.
Okay. Would the bent of an investor like you who is adept at identifying long-term themes which are not known to the markets at large or not discovered well, would the bent of an investor like you be towards larger stocks now, considering that there is a bit of a pressure at the broader end of the spectrum, or not quite?
Yes. So from a relative value perspective, you're absolutely right that we find more value in large caps versus mid and small caps. Just to put in context, what typically happens in every bull market, and this happened in this bull market also, at the start of the bull market, so in March 20, when the bull market started, mid caps and small caps were trading at 20, 30, 40% discount to the large cap indices. Today, we are at a stage where the mid cap index and the small cap index are trading at premium to large cap indices, again, which is very normal in a bull market to happen. So obviously, valuations in mid cap, small caps are extended. From a relative value perspective, we find more value in large caps. Having said that, we find enough number of mid caps as well, or small caps as well, which are far more quality oriented with solid business models, and which will still do well over the next 3-5 years. So we find value on both sides, but on the relative value perspective, you're right that large caps looks more attractive at this point of time from a risk-reward ratio perspective versus mid and small cap.
Okay. Well, one more reason for stress in the mid-cap and the small caps, viewers, is several fund houses declaring the results of the stress test. Now, in case you're wondering what that is, Alex joins us with some very quick details of the same. Alex.
Absolutely, Niraj. So I was speaking to the chief risk officer of one of the mutual funds here just to get clarity on some of the aspects that were unclear. And one of the most important points, of course, is that cash is included in the calculation. The other aspect to remember is that what they're using to calculate this methodology is days to liquidity, which means that the 80% of the portfolio that they're taking, which is the most liquid stocks, how much time does it take for the least liquid of that to complete? So what that means is, suppose you get a day of 56 days to liquidate that 80%. You divide that by half and you get 50%, right? So what that means is that it takes you 28 days to liquidate the half point. I hope that I'm explaining this correctly. What that means is that you can actually have what is called a days to cash, which means that you can sell both your most liquid and your least liquid stock on an ongoing basis, on a pro rata basis, and you can liquidate actually on a daily basis quite a considerable chunk of the AUM. So the Chief Risk Officer was explaining that while on the face of it, some of these numbers might look stark, it may not necessarily present the exact picture on liquidity. They first of all can meet up to 5% in cash, and then on an ongoing basis, 2 to 4%, 5% in some situations, they can meet basis selling on an ongoing basis, Niraj.
Thanks for putting that into perspective, Alex. Pankaj, you've got past experience of being such a large manager in a large AMC. Is this stress test a big nervous development, or is this something that is acceptable?
No, not really. I think it's a good development that the regulator is being proactive and asking fund houses to disclose some more statistical details about the funds so that investors have access to this information, and more importantly, they can take informed decision. I believe because there's been some of these conversations around big bubble and mid and small caps, I think there are pockets of markets obviously there where there could be fraud, but I don't see it overall at the aggregate level there's a bubble in the indices. Indices can correct, but I don't see them collapsing or being the peak of the cycle or anything of that sort at this point of time. And the other thing I want to highlight is, see, that's the nature of the beast. Equity markets inherently are prone to bubbles, manias, and busts. They happen every decade. You get one such cycles because equity markets are driven by greed and fear. So some of those things will happen because that's the inherent nature of the beast. So I think the incremental information disclosure is pretty good because it gives investors more information at their hand or at their disposal, and probably they can make more informed decision.
Got it. Pankaj, the other aspect is while people are betting on emerging themes, the most sure shot bet seems to be the ability to bet on where the pie is visible, which is the government's focus on capex, maybe manufacturing, and pulling all stops out while private capex hasn't come in. So amongst the safe bets, if you will, valuation taken into account, would you believe that all things considered, it still remains this capex / manufacturing piece, or are you looking at other things being the number one priority for you?
No, so you're absolutely right. I completely agree with you, Niraj, that we are seeing a very strong revival or comeback of India's investment cycle. Primarily, obviously, public investments, or as you said, the government investments have been very strong. But I see very strong incipient signs of revival of private sector capex as well. And I see post-elections, we should see a very significant rebound in India's private sector capex because corporate balance sheets are very healthy. Corporates' profitability is at all-time highs. Corporates are making huge profits, and they're sitting on balance sheets are delevered. More importantly, banks or financial institutions are in good shape and their balance sheets are healthy with strong profitability and low NPAs, which is important because they are the ones who want to fund the capex or investments through the debt by lending. So I think overall we've reached an environment where underlying demand in the economy continues to remain strong. Most of the companies are reaching capacity utilization which are north of 70%, which effectively means they have to start planning their capacity and execute those capacities. And I see that across sectors, sector after sector, in each of the core sectors, I see very strong investments. Also, as you rightly said, this is also driven by a revival of India's manufacturing, driven by China Plus One and PLI incentive, which the government is rolling out across sectors. So I think a combination of all of this, I think India's manufacturing revival story and the capex story or investment cycle story looks very compelling. I'm firmly in the camp that all of us are underestimating the potential growth impetus out of revival of India's investment cycle and revival of India's manufacturing. So I think this cycle will surprise us on the upside big time.
Pankaj, we've spoken at length about some of the themes that you've liked. Now, the reason why it's important to rehash or highlight some of those again is because valuations may actually have become reasonable in some of the broader market themes for sure. So post Q3, post commentary, post the shakeout in the mid cap and the small cap space, what stands out as numero uno amongst the emerging themes?
So while, as I said, Niraj, the whole engineering and capital goods space riding on back on investment cycle continues to remain our one of our preferred themes or bets and companies within the sector, because we think some of the fastest growing companies of India over the next 5 years will emerge from that sector. Apart from that, we've been fairly positive on healthcare and IT as a sector, because we think one, IT is coming out of a prolonged slowdown of the last 18 months, and we see strong signs of revival of IT investments by global companies in the second half of this year, and Indian IT companies should be a big beneficiary of that. So we've turned pretty positive on IT as a sector. We like healthcare as a sector because we think the sector has done well in the last 9 months or so, but we still think that there's still strong growth ahead of the sector, because primarily because pricing pressure in US is off the table. We're seeing significant price improvements in US generics market, and which will significantly benefit Indian companies. And we also think financials which have underperformed for a broader part of last year should make a comeback in the second half of this year. So these are some of the things or companies within these themes are what we like, Neeraj, in terms of what we are owning. What we are underweight is actually consumers. We think the economy has gone through cyclical consumer slowdown over the last 12 months, and it got accentuated because of a poor monsoon last year. Probably it will be time to revisit it post monsoons in the second half of this calendar year. Having said that, the sector also had headwinds of very expensive valuations, and on top of that, when you have a cyclical slowdown, which is what we've seen, consumer companies have actually underperformed over the last 2 years. So we still continue to remain underweight consumers as a sector.
Interesting. When you're betting on IT, Pankaj, and you track this so closely, I find it difficult to debate with you at all. But the point is at least the recency of trends. I mean, there's this Naukri JobSpeak IT index which showed the hiring. That is also not picking up. So what gives you this confidence about a change in trend at all?
Neeraj, there is a very fundamental shift that is undergoing in the world, and which is probably we are maybe 4 quarters ahead of the cycle, and that's all driven by this generative AI. I think in my my professional career of 26 years, this is the biggest transformation that I'm seeing is going to take shape in the IT industry worldwide, and will change life for each and every industry and consumers all over the world. Businesses will have to prepare for that, and they'll have to make significant investments to transform themselves to meet the expectations of the consumers as consumers transform themselves, adopting AI solutions. So I think we are at a cusp of a point, maybe probably 4 to 6 quarters ahead, where we'll see the biggest investment cycle in IT sector, which will play out globally. I think this wave of IT spend that we'll see over the next 5 or 10 years, typically IT spending cycles, when you get a new technology, that wave lasts for probably anywhere between 7 to 10 years, which is what I've seen in the past with, let's say, the enterprise wave or the cloud digital wave and so on and so forth. I think this wave of IT spends that we'll see over the next decade will be bigger than any of the previous IT investments or IT spend cycle that we've seen in the last 30, 40 years in the world. So when I look at the IT industry from a slightly more medium-term to longer-term prism, I feel very excited about the prospects of this industry. As I said, we could be probably 4 quarters ahead of the street or of all of this actually translating into business growth for companies, but I think it's certainly coming.
Okay.
We as investors tend to take a slightly more medium-term, longer-term view. So we like to be 4 quarters ahead of the actual business cycle turning around. So we like to be slightly ahead of the street in terms of placing our investment bets, and then wait for that tide to turn and then reap the benefits of growth in underlying businesses. So which is why it's our DNA to be slightly ahead of business and investment cycles.
Okay, well. Slightly ahead, and sometimes it pays rich dividends if you can identify it well. Remember, Pankaj Started off his career as a tech analyst, has studied this space for 30 years now, or maybe more, and therefore understands this space slightly better than what most other people would. Pankaj, take a moment to thank you for joining in today and giving us your thoughts on the show. Much appreciate your time.
Thank you very much, Niraj. It's a pleasure as always talking to you.
Yeah, likewise. And viewers, thanks for tuning into this edition of The Talking Point.